the 2nd of July 2025, right? So what's in store for us today? Right, today I want to talk a bit about tariff deadline looms amid dollar weakness, marking a shift from past trade disputes. Uh, um, as of July 9, tariff deadline approaches. Negotiations between the US and major trading partners such as Japan, the EU, and Canada remain unresolved. Now, while China signed a trade agreement with the US on June 26, financial markets are now reacting to a more defining shift in the form of broad-based weakness in the US dollar. Now, unlike in previous trade conflicts where the dollar typically strengthened on safe haven demands, this cycle presents a markedly different picture. Now, today's market dynamics reflects the influence of expanding US fiscal deficits, dovish outlook from the Fed, and eroding yield advantages that once supported the dollar globally. Now, for the US dollar, in previous trade conflicts, right, tariff announcements typically triggered a strong US dollar. Investors regarded the greenback as a reliable safe haven asset in times of geopolitical and economic stress, often moving capital into US treasuries and other dollar-denominated instruments. Now, the US benefited from this global reserve currency status, its deep and liquid financial markets, and its perceived institutional stability. Now, these factors combine to make the dollar the default destination for safety-seeking investors during market shocks, including tariff-related episodes in the past. Now, this time, however, the situation is unfolding differently. Despite rising trade tensions and unresolved negotiations with several major partners, the dollar is weakening rather than strengthening. Now, the reason lies not in short-term sentiment, but in the growing unease over the structural foundations of the US economy. Now, concerns over countries' fiscal path have intensified. Now, the US is grappling with a rising debt to GDP ratio, persistent budget deficits, and growing political gridlock that limits its ability to implement credible fiscal reforms. Markets are increasingly questioning the long-term sustainability of the US fiscal position. Now, this erosion in fiscal confidence weakens the dollar's appeal as a long-term store of value. Even in times of global uncertainty, when the dollar would typically attract inflows, investors are now diversifying toward other major currencies and assets. Now, the expectation that the Fed may soon begin cutting interest rates only adds to the pressure, reducing the yield advantages that previously supported dollar strength. Okay, here I'm referring to the interest rates. So, everyone expects that the Fed would be cutting. In fact, yesterday we had Powell saying that we are not discounting the fact that, it is for sure we would not cut rates in July. Powell did not want to say that. Okay, so now, so what happens here is that as a result, the current dollar decline right now is not merely a reaction to trade policy, but a broader reflection of shifting global perceptions about US credibility and stability at the moment. Something which the government, the US government, as well as the Fed is trying to protect over here, right? So right now we're seeing this decline happening, and if Powell says that they will start cutting rates, and do it in an aggressive manner, yeah, you could actually see more weakening. But nevertheless, this is not something that is set on stone. Things can change with different policies coming in. Okay, so let's see a bit. That's for the US dollars. As for the Japanese yen, the Japanese yen is strengthening ahead of the July 9 tariff deadline, supported by both safe haven demand and a weakening US dollar. Now, unlike in past trade conflicts where the dollar typically attract inflows, investors are now turning more decisively toward the yen as talks between US and Japan remain unresolved. Now, President Trump has publicly criticized Japan for refusing to import more US rice, calling the country spoiled and highlighting what he sees as unfair trade practices. In response, Japanese officials have stood firm, stating that they will not sacrifice their agriculture sector, especially politically sensitive rice farmers, to gain tariff concessions. The rice, farmers really hold a lot of political clout in Japan, right? So the yen is seen as a defensive currency, not only because Japan's low inflation by global standards and stable political environment, but also due to its status as one of the largest foreign holders of US treasuries. Now, in times of global uncertainty, Japanese investors tend to repatriate overseas assets, particularly from US bonds, which boost demands for the yen. Additionally, foreign investors view Japan's deep capital markets and strong net international investments position as a sign of resilience, marking the yen a preferred safe haven in risk-off environments. Now, with the US threatening to reinstate 25% tariffs on Japanese autos and no resolution in sight, these structural factors are reinforcing the yen's strength as trade tensions escalate. Now, the Japanese yen may weaken, causing the dollar yen to rise if markets begin to unwind safe haven positions and shift back into risk assets. Now, this could occur if progress is made in trade talks between the US and Japan ahead of the July 9 tariff deadline, reducing uncertainty and calming investor sentiment. Okay. Next is the euro. While the Fed has not officially begun cutting rates, markets are anticipating multiple rate cuts within 2025 due to softening economic data, falling inflation expectations, and concerns over fiscal sustainability, right? As of late June 2025, futures markets were pricing in at least two cuts before year end, with the first expected as soon as September. This anticipation alone is enough to weaken the US dollar even before the first actual rate cut happens. Now, the European Central Bank, having already started a modest easing cycle earlier in 2024, is now seen as nearing a pause. Recent ECB minutes suggest no urgency for further cuts, especially with energy inflation stabilizing and wage growth holding in Europe. Now, this divergence in future monetary path, with the Fed expected to ease more aggressively than the European Central Bank, is supporting the euro. So unless the US unexpectedly imposes steeper tariff on European automobiles and machinery, severely denting business confidence and manufacturing output across the Eurozone, Euro US dollar is likely to remain on a bullish trajectory. Now, for Canada, the Canadian dollar is strengthening in the run-up to the July 9 tariff deadline, reflecting a clear divergence from its behavior in the past trading conflicts, right? Previously, the loonie would often weaken in response to tariff threats, particularly due to Canada's close economic ties to the US and its resilience on cross-border trade. However, this time the broader weakness in the US dollar is overriding those typical reactions. Now, despite unresolved negotiations, most recently concerning Canada's now suspended digital service tax, investors are positioning for a more constructive outcome, or at least a less aggressive fallout. Now, in addition, stable oil prices and Canada's relatively sound fiscal position are supporting the loonie. Markets are also pricing in fewer rate cuts from the Bank of Canada compared to the Fed, reinforcing the currency's relative strength. Rather than reacting solely to trade risks, the Canadian dollar is moving with global capital flows away from the US dollar and into currencies backed by stronger fiscal credibility and commodity-linked fundamentals. While a breakdown in talks with the US could still trigger volatility, The current environment suggesting that Loonie is less exposed to downside pressure than in previous cycles. Okay. Next is the S&P 500. The S&P 500 has demonstrated remarkable resilience in the face of ongoing trade and tariff tensions. After plunging more than 15% in early April following President Trump's Liberation Day tariff surge, the index rebounded sharply by late June, closing the first half of 2025 at an all-time high around 6199.3. Okay. Now, this recovery was fueled by several factors, including easing trade jitters, stronger than expected corporate earnings, particularly in tech sector, and investor positioning for anticipated Federal Reserve rate cuts. Now, the market watchers note that the dollar's weakness injected a further boost into exports and foreign earnings translation, supporting valuations despite unresolved trade negotiations. Nevertheless, analysts caution that the July 9 tariff deadline could spark renewed volatility. June's market rally coincides with trade optimism, such as Canada pausing its digital service tax and China finalizing a deal, but that narrative could reverse and trigger sell-off similar to those seen in April when the S&P 500 dropped more than 5% in just 2 days. Still, strategies from Morgan Stanley and other institutions argue that the S&P remain supported by strong earnings revision momentum, expectations of a accommodative monetary policy, and broader structural tailwinds. Now, these factors are seen as providing the market with room to advance in the second half of the year. So what we are also doing, waiting for is the Trump's One Big Beautiful Bill that is about tax cuts. Now I'm waiting for them to finalize it, then understand what it has been approved, what hasn't, what changes were made, and from there, I'll come up with another report in the future video, and then you can see, how that could actually be a broader structural tailwind for the S&P 500 as well. Okay, so I'm waiting for that to happen. We are seeing the US market rising also because of that. But let's see, let's wait. So what you have just now here is basically highlighting in this sharing and highlighting all the currencies that could of the countries that haven't really settled their tariff discussions with the US as yet. Okay, China, they have done it. So we have Japan, the European Union, Canada, and these three main economies. They haven't finished discussing with US as yet. Okay, so if they don't, then situations that I discussed just now, that could actually happen. Okay, so in summary, the current landscape represents a break from the past-driven market behavior. The US dollar is weakening in the face of unresolved negotiations, a stark contrast to previous cycles where the dollar served as a shield against uncertainty. Major currencies such as the yen, euro, and Canadian dollar gaining not just on relative strength, but because the dollar itself is no longer drawing the same safe haven flows. Now, the shift has implication for both currency and equity markets, where the effects of trade tensions are being filtered through a different macroeconomic lens than in past years. Now, as the deadline approaches, markets are adapting to a world where the dollar is no longer untouchable, and that creates that kind of volatility in the market. And though it's not a time where I know if you listen to certain economies and gurus, right, they're calling for the death of the US dollars. Though the power, the status, US dollars, the power in say day by day is eroding, it's not expected to be of immediate threat. Okay, and believe the US is doing a lot of things to bring back, to tip back the scale, the power scale back to the US dollars. We shall see, in the coming months and years how they will try to protect the dollar strength. Okay, so with that, that's the report for today. Let's move on to the chart.